Hello and welcome to Beacon Pointe's Fiduciary Point of View webinar series. This is our third webinar of many planned for 2019. As a quick introduction, I am Michael Rocco, a retirement plan consultant at Beacon Pointe Advisors. Beacon Pointe is a registered investment advisory firm located in Newport Beach, California, that currently advises on $9.6 billion in assets. We'll be hosting a new Fiduciary Point of View webinar every 4 weeks on various topics pertaining to the defined contribution industry, in both for the for-profit 401k space, as well as the not-for-profit 403b space. Our goal is to bring to light various topics for both our clients, as well as the general plan sponsor community, and bring in experts in the respective fields to educate and inform those in attendance. Our topics will discuss various areas such as solving the millennial challenge, new trends in the 403b not-for-profit space, and common compliance issues discovered in plan audits. Today, we are going to cover the evaluation and selection of target date funds for retirement plan sponsors. Before we start, here's a quick snapshot of the purpose and growth of target date funds. The main impetus for target date funds stemmed from participants voicing their desire or foregoing self-portfolio management of their retirement assets. They wanted an all-encompassing product that prudently diversifies across multiple asset classes and rebalances over time to become more conservative when they approach retirement. Target date funds were first introduced in 1994. Since their inception in the 90s, the asset size within the target date space grew to $15 billion by 2002. Then, by the end of 2008, the asset size soared to $179 billion. Over the next decade, the asset value reached over $1 trillion for target date funds. Given the rapid growth in the target date space, selecting the appropriate target date fund is perhaps the most important investment decision a plan committee can make. Today's discussion will revolve around the evolution of the target date fund space, challenges in identifying key risks faced by participants, and providing a framework for making an ideal selection. We are very excited to introduce our speaker joining us today, Peter Cavallini. Peter Cavallini serves as a Strategic Account Manager with PGIM Investments DCIO team. In that role, he works with the research teams and practice leaders of many of the largest consulting firms nationwide. Before assuming this role, he served as a vice president on PGIM's product team focusing on Prudential's Day One target date funds. Previously to joining PGIM Investments, Peter worked as head of investments and lead consultant for a large national consulting firm. Peter earned his BA with honors in economics from Rutgers University and has earned the right to use the Chartered Financial Analyst CFA designation. We have a lot to cover this morning, so with that said, I'd like to turn it over to Peter.
All right, well, thank you very much, Michael, for the introduction and the setup. I also just want to thank everybody on the call for investing the time on target date funds and being on this call. As Michael mentioned, I started as a consultant working with many, Fortune 100, Fortune 500 companies around the country. And I can tell you, they could debate and discuss the S&P 500 and the basis points and the impact for all of this little minutia. But I can tell you this, few were spending the time necessary to fulfill their obligations when it comes to target date funds. Really what I want to do is, over the next 25 minutes or so, and I say this somewhat tongue-in-cheek, is but to make you all experts in the realm of target date funds. I think in doing so and going through this framework, I think you'll put yourself in the best position to select the ideal target date fund for your participants, but even better, as a fiduciary, by selecting the best target date funds for your participants and guiding them through that process, you're going to be doing the best thing for yourself as fiduciaries. So following up on some of the stats that Michael highlighted, why is this asset class so important? It's because this is where the money is, and this is where the money is going. Really, nearly all the money is going. A few quick stats. Some things are not so surprising. Target date funds are the QDIA on the vast majority of DC plans nationwide. Pretty simple. Target date funds represent nearly a third of all assets inside of defined contribution plans. And not that surprising if you've been reading any of the industry magazines or periodicals. That last one, that is important. 92 cents of every dollar going into a DC plan is going into a target date fund. Now, why is that important? And the reason why, there's a number of reasons, right? And because getting it right for target date funds and making the right decision is vitally important as to whether or not your participants are going to be able to retire comfortably at the time of their choosing with some expectation about what their life is going to be like, or not being able to retire at all, because this is their primary investment and the primary savings vehicle. But the other part of it is the fact that because all the money is going there, this is where the lawyers are looking, right? This is going to be the next shoe to drop when it comes to litigation, right? It's like the old line about Willie Sutton. Why did he rob banks? He said, this is where the money is, right? And this is where the money is going inside of retirement plans. So this is where the lawyers are looking. So how do we avoid litigation? Well, luckily, our friends in Washington have given us some very clear guidance. And for those of you who have been paying attention, back in 2013, they released the DOL tips for ERISA fiduciaries, plan fiduciaries, which you can see here. And it was actually surprisingly helpful. It gave us a process for periodic review, understanding the glide path, understanding fees, the proprietary considerations, and most of all, documentation, which is something that a theme that we're going to be highlighting a few times here. And the other area where we can learn lessons is legislation and litigation. And for those of you who spend a lot of time thinking about their fulfilling their fiduciary obligation, you'll see there are some lessons learned. First and foremost, some target date fund legislation focused on going with the cheapest. So just absolutely finding what is the cheapest, least expensive target date fund, and those plan sponsors and fiduciaries got in trouble. Or selecting the target date fund that had the highest returns, at least for some narrow, brief period of time. They got into trouble. And then lastly, the target date fund selection that focused on, well, with XYZ record keeper, why not just go with XYZ target date fund without doing any of the sort of due diligence? Well, what do those three sources of litigation, what do they have in common? It's that the committees couldn't explain why they did what they did. And that's what gets you into trouble. So what I like to do over the next few seconds is show you why having a thoughtful process and documenting that process, which is really, it's going to be the chorus to our song over the next 20 or 25 minutes, why it's so important, and explain that these strategies are not all created equal. So what this chart represents is what's called a glide path. And a glide path is essentially, it's a visual representation of the opinion of asset managers and how much risk they think you should be taking at different points in your investment lifetime. That's a mouthful. Basically, what is the mix of risky assets like stocks and non-risky assets like bonds over that time period? What you see here, this target date, this is how much risk they think you should have the day that you retire. So there is one asset manager out there that thinks the right number is 61%. 61% of your assets should be in risk assets. Now, there's another asset manager, assuming they're equally competent, equally smart, that have arrived at a very different conclusion. They think that 22% is the right number. Now, one of the things I can tell you is these are both 2020 target date funds. These are the target date funds that you would be in if you were right on the cusp of retirement. And yet they have wildly different strategies, wildly different risk profiles, wildly different return profiles. And I can tell you, looking in and digging deeper is super important. And the reason why is because of the lessons that we learned during the financial crisis. And it was a traumatic and terrible experience for basically everyone involved, right? Whether you're a saver, a retiree, a plan sponsor, whether you're a fiduciary. The bright side of it, if there was any, was that it allowed us to see what sort of risk that people were taking, right? And there's an old line, was Warren Buffett, who said, you don't know who's swimming naked until the tide goes out. Well, it turns out there were a lot of asset managers out there that were throwing caution to the wind, and this highlighted it. So what you see here is 8 of the largest asset managers during the financial crisis. These are all 2010 vintages. So again, the shell is identical. Every single one was 2010. And you can see one manager, Target Date Fund A, had a negative 20% return. That's not fun. That's not fun for anybody involved. Waking up and finding out that all your worldly assets or your retirement assets are down by 20%, not a good look, right? They wouldn't be happy. But compare and contrast that with someone who had the misfortune of investing in Target Date Fund H that lost double that at 41%. Can you imagine what it would be like to starting your retirement with a 41% reduction in your assets, having to reduce your standard of living by that much? And quite frankly, a lot of the people in Target Date Fund H, I won't name them, that resulted in litigation and lawsuits. And in fact, just as an aside, Target Date Fund H no longer exists. The strategy actually had to be shut because of just the bulk of redemptions and the amount of litigation surrounding it. Getting it right and understanding the risk embedded in these strategies is vitally important. So how do we avoid the fiduciary risk? How do we avoid selecting target date fund manager age. And really what it comes down to is, and again, that chorus again, it's having a thoughtful process around selection, digging in and understanding what you're buying. And what we're laying out here is a very simple framework, but what we think is very powerful. And I think if you focus on these 4 areas of focus, these modules, focusing on the glide path, performance, the 3 Ps, people, process, and parent, and expenses, you're going to uncover and reveal all of the most pertinent data regarding these target date funds. In fact, this is very much like the strategy that I utilized in working with my clients in a former life. It's impossible to have a sound DC strategy, a sound 401k or 403b plan without a target date fund strategy. And likewise, it's impossible to have a good target date fund strategy without understanding the glide path. It is central to the strategy, it is central to the opinions, to the objectives that the asset manager are trying to solve for, and it's important that you get it right. And that's why it's the first thing on our list. Taking a step back, Prudential is a target date fund manager. We manage our own, and when we were developing our target date funds, we started with a pretty shockingly simple concept, and that was that, and observation, that people face different risks in different proportion in different times of their life. So the risks that a 20-year-old faces are very different than somebody who's on the cusp of retirement. And those risks are very different than somebody who's been in retirement or drawing down those assets. So the concept was simple, and that is if we can identify the key risk that people face and hedge that risk when that risk is most pernicious, right? When it's most acute, we're going to get more people across the finish line. And that was our strategy, start to finish. That is a strategy for developing a target date fund. But what I would argue and what I would submit to the listeners is that is an equally powerful strategy for selecting the best target date fund for your demographic, right? And that's irrespective of whether you have 4 million participants that we used for our record keeping platform in order to create our strategy, or whether you have a 40-person employee base that you can use. If you can identify the key risks, you're going to be able to hedge those risks and you're going to help more people. And that's the strategy. And that's really the framework. So how do you arrive at that data? How do you identify the key risks? It starts by asking the right questions. If you ask the right questions of certain demographic groups, and I don't mean literally asking them questions, but if you peer into this information as a committee and you identify the key risks that millennials face, that young people face, that people who are on the pre-retirees or people on the cusp of retirement, and people who are in retirement face, and you understand the challenges and risks they face, selecting that ideal glide path is much easier. First things first, let's talk about a demographic that confounds HR people, CFOs, CEOs, managers everywhere, and that's the millennials. What we did is we actually looked at some very significant and very powerful metrics. And what we looked at was, what is their average account balance? What is their average salary? How much are they deferring? Well, do they go with the flow when it comes to auto features like auto enrollment and auto escalation? Are they staying with the firm, or are they switching jobs every 3 years as the reputation suggests? And then also, what is their risk tolerance? And what we found out is that millennials face very real challenges. Number one, they tend to save less, and their deferral rates are lower than just about any other demographic. Adding insult to injury, they earn less than any other demographic. So that's really a double whammy. They're earning less and they're saving less. That's not good. And then lastly, they had the highest degree of risk aversion of any other demographic. So they were actually taking less risk when left to their own devices than their parents or their grandparents. So for us, the risks became obvious that they weren't saving enough, they were getting insufficient portfolio growth, they weren't taking sufficient risk. And that was a real challenge, which was going to prevent them from being able to realize their goals 30, 40, 50 years from now. What I would suggest to you is not that you're going to see the same risks, but by asking these questions, by digging into account balance, salary deferrals, tenure at the firm, and risk tolerance, that is going to point you directionally to figuring out the key risks they face, and then from there, solving for that risk through selecting the ideal glide path. That's the first stage. The second stage is really, it's an interesting one. And I would say that if there's one slide that you want to screenshot, take a picture of, this is the one. And what I used to discuss with my clients is that being a fiduciary is not unlike being a parent. You love all of your kids equally, but maybe there's one or two that you're a little more concerned about, or one or two that needs a little bit more attention than the other ones. When it comes to retirement plans, those people who are on the cusp of retirement or near retirement, these are those same people. These are those children that need a little more attention. And the reason why is because they present, frankly, the greatest risk to you as a fiduciary. The reason why is because they're the people with the biggest account balances, and therefore they're the ones with the most to lose. They're the ones that are most concerned with their account balance, right? I found that they're checking their account balances 2, 3, 4 times a day, even though it only changes once a day, which I thought was strange. These are the people who are most expensive to employ. So if they delay retirement, they have the highest healthcare costs, they have the highest compensation generally. They're the ones who are often likely to get injured on the job. So getting it right with them really can't be overstated how important it is. These are the people that are most likely to sue in the event that they can't retire on time. In addition to asking all the same questions that you asked of the millennials, you want to dig in to some other things as well. So you want to look at their ability and willingness to take risk, their sophistication. Can they rely on a DB plan or some sort of supplemental plan? Here's another question, and this is a behavioral one. How did they react and how did they respond behaviorally during the financial crisis? Did they inundate HR with phone calls? Or did they stay the course? How did they react behaviorally? Are they staying in the plan post-retirement? Can they rely on an in-plan guarantee? And just as I mentioned, folding over the page or putting an asterisk next to something, I would say put it next to this one as well. Can they choose the timing of their retirement? And I would say that there is no other metric that's more powerful in determining how much risk people can take than this one. And what we found out when we peered into our plans, for many people, they don't have the luxury of choosing the timing of their retirement. Retirement is something that was thrust upon them, either through bad fortune or an injury or an illness of themselves or a loved one. The fact that they couldn't choose the timing of the retirement meant they were subject to the whims of the market, right? Which can be bipolar, to say the least. So because of that, it really pointed to us directionally to how much risk can people take, and we found that it was a lot less than they anticipated, and that the primary risks were market volatility and abandoning the plan, meaning getting scared, and I'm sure you probably know friends or family that say, I can't take the volatility anymore, and went to cash, usually at the bottom of the market. These were the primary risks that we identified. What I would challenge the people listening to do is take these same questions, peer into your own plan, and find the key risks that your participants face. And that will point you to how much risk they can take at that pivotal time, which will tell you what is the ideal glide path. That's the second stage. We're going to go on to the third stage, and that's for people who are already in retirement. Now, for a lot of people, they say, well, look, these people may already be retired. I have less of a concern. But as a fiduciary, you have an oath to look after the interests of everybody in the plan, retired or active or inactive. And what we found out is they face different risks. And also, we asked slightly different questions. Of course, we asked about risk tolerance and drawdown rates and how much they're taking, and in-plan guarantees, and whether they can rely on a DB plan or some other supplemental, cash balance plan, for example. Here's some interesting ones, though, that very few people are talking about, and that is, where are they retiring, right? Are they retiring in New York, New Jersey, or California, a place with a high cost of living? Or are they retiring in Kansas or Nebraska? That's going to be important about that income replacement ratio. What are they spending their money on? Here was another one that our product team and a lot of the analysts thought about was, what was the nature of their job, and will they be subject to high healthcare costs in retirement? Are the things that they're buying subject to higher inflationary pressures? Housing, rent, energy, food, and again, healthcare it almost bears repeating because it's so important. When we looked at our own record-keeping platform, we found that purchasing power or inflation risk was a pivotal concern. It was also market volatility, so drawing assets down while the market is oscillating. But again, what I would challenge you to do, again, I sound like a broken record, but look into your own plan, ask these questions, and see what risks you identify. And that will be your guiding light into selecting the ideal glide path, which is central to selecting the right target date fund for your participants. Performance. This is the next big one, and this is where the rubber meets the road. And this one should be pretty simple, right? Just select the target date fund with the highest returns and cross your fingers and hope for the best, right? Well, hope is not a strategy, and I'll prove it to you. So imagine yourself, we're 9 years ago in 2010, and we're selecting a target date fund. The only information you have in front of you is how they did last year. And if you looked at these three managers, you'd say target date fund A, B, and C. Well, there's one clear victor. Target date fund A is impressive numbers, almost 30% returns. Seems like pretty much a no-brainer, right? Until you get a broader context. And you look to see how did that manager do in the previous year in 2008. And it turns out the manager with the highest returns in 2009 had the worst returns a year prior, right? So that risk and return are two sides of the same coin. What's the challenge? The challenge is that for those investors that invested in target date fund A, even after 2 years, they still hadn't gotten back to where they were. And you add the element of drawing those assets down and depleting them at the worst possible time, it would take years. It would take quite a while to ever get back to where you previously were. And that is the challenge. And something else that we found out in talking to plan participants is that 83% said they were willing to give up those returns on the upside in order to protect on the downside, which is entirely consistent with a lot of the behavioral stuff that we've seen that showed that the pain and the acute feeling of loss is significantly greater than the reward. That's something that we suggest that committees think about when they're developing their target date fund strategy. Just like we gave you a 3-stage process for thinking about the perfect glide path for your participants, we're going to give you a 3-stage process for evaluating that performance. Early on, young investors, what do they care about or what should they get? It's all about long-term returns, getting the highest possible returns, because if the markets are volatile and they're investing with a 30 or 40 or 50-year time horizon, volatility isn't a risk. Volatility is an opportunity to buy the market on sale. So that's what we're looking at. We're looking at Sharpe ratio, which is something that the folks at Beacon Pointe can help you with in addressing how much risk relative to return. Assuming you think the glide path makes sense for you, you want to see if they're keeping their promise. Are they keeping up with their custom benchmark? And if they're active, are they earning back their fees? If they're near retirement, those metrics change, they shift. Just like the questions shifted and the risks shift, so should the metrics that you use to determine whether managers are keeping their promise. And this is all about protecting on the downside, right? It's how do those managers do when markets decline? What does their risk-adjusted numbers look like? Meaning, how much risk do they take relative to the returns? What are their drawdown numbers? What is their downside capture ratio? And also, again, are they keeping their promise? How are they doing relative to their custom benchmark? And are they earning back their fees? And then lastly, with retirees, it's a lot of the same metrics, but one of the things that you really want to focus on is, are they maintaining the purchasing power relative to inflation, relative to the sort of inflation that people in retirement are experiencing? If you follow these metrics, which are entirely consistent with the framework we laid out earlier, you'll be able to ascertain whether the managers are doing the right thing by your participants and achieving their objectives. Next thing is all about the 3 Ps. It's people, process, and parent. And this is really much more qualitative. And here I would suggest that you rely on your consultants at Beacon Pointe to help you with this, because they have the resources, the people, the acumen to really dig in to see whether the asset managers, the firms, have a consistent, repeatable process that are going to allow them to really execute going forward. And really whether that asset manager is worthy of your trust. And so it's a bit of art and science, but one of the things, if you're going to trust a target date fund manager to manage your large cap and your mid cap and your small cap and your fixed income and your emerging markets and your real estate and any other asset under the sun, you want to know that they can execute. Just like a chain is only as strong as its weakest link, a strategy is only as strong as its weakest strategy within it. So you want to know that they can check all those boxes, they can execute across the board, and that they're going to be able to generate those returns. Secondarily, when you get into the process, it's more than just the ingredient. Good, you want to make sure that they can put them together in a cohesive way, that they understand asset allocation, that they have the teams, the capabilities, the resources, and they've devoted the resources to make an asset allocation work. And then lastly, and we really see this as almost for us at Pru, we see this as a secret weapon, and that is the record-keeping insights. So if you have the science and you have the capabilities, do you have the insights about how participants react, how they respond behaviorally, what the ingredients are for good outcomes, and then you can use that data in order to replicate those good outcomes inside of the target date fund strategy. And you combine these 3 things, they're much more qualitative in nature, but if you focus on this, it'll allow you to separate those lucky managers that just happen to have some decent returns from the ones that are going to thrive going forward. And lastly, expenses. It's something that's frankly on the tip of everyone's tongue. And assuming you've done everything right, you've vetted the glide path, fit it to your demographics, performance looks good, asset management, you have nothing but the utmost confidence in them, but the expenses are 5 or 6 times where everybody else is, you've got a problem. So what's the best way to look at fees? And what I would say, there is no perfect way. It depends in large part about the sort of target date fund you're selecting. And you're not required to choose the cheapest target date fund. In fact, there was a lawsuit about a committee that chose the cheapest, and when they asked them, they said, why did you choose this strategy. They said, well, as a fiduciary, we just wanted to choose the cheapest to keep ourselves out of trouble, which is the worst thing you can say, because you were saying you were only looking after your interests, not those of your participants. So it's not about choosing the cheapest, it's about choosing a strategy whose fees are competitive for services rendered. I think ERISA uses language such as that. How do you look at it within the prism of target date funds? If you have an active manager, right, so you've got managers that are turning over rocks and looking at opportunities and buying stocks and bonds they think are undervalued and avoiding those they think are overvalued, there's an infrastructure and a cost to that. Obviously, you want to look to see, are they competitive in terms of fees? Next, are they earning back those fees? And then lastly, something that we always talk about is you want to look to see, are their fees competitive, but are they taking any undue risks in Sharpe ratio? Now, on the other side, we've got passive, right? And passive is all they're trying to do is replicate the returns of an index, the S&P 500, the Russell indices. And the upside is the costs are very, very low and increasingly competitive. Obviously, you want to make sure, given the arms race that's taking place, you want to make sure that your fees are low. But you also want to look at things like tracking error. So if their goal and their objective is to replicate the S&P 500, how effective are they at doing that? And then when they put it together, how much risk are they taking in Sharpe ratio? The combination of active and passive is something called hybrid. And this is where you're getting into not just performance and fees, but also value. So are they earning back their fees, right? So you've got this combination of active and passive. And then also, what is essentially the question of active per basis point of expense is, what is the value? So if you had a strategy that was 99.99% passive and just a drop of active, you would expect those fees to be very low. But that's something that you want to peer into. If it's a combination of active and passive, what is the balance, and are the fees competitive relative to the amount of active management? And again, that's something that the folks at Beacon Pointe can help you with. And then, as always, risk-adjusted returns are important. Again, that chorus throughout our song is document the process. That is the key to staying out of fiduciary trouble. Again, I sound like a broken record, and I apologize for that. This sums it up. It's the important process. And I'll end by sharing just a quick anecdote. I had a conversation with one of those lawyers that are out there suing everyone. It was at a conference, and I pulled them aside, and I said, look, as somebody who used to be a fiduciary, what are the things that we could do in order to coach people about how to avoid the perils of being a fiduciary? What they told me was not shocking, but it was powerful. And that was that if you document your process, if you have a thoughtful process and you apply it consistently, that is as good as it gets. And the reason why is, in the absence of information, if you don't have clear information, the lawyer's job is to fill those gaps with the worst possible intentions. And what they said is that if you have a documented process, if you have a thoughtful process for why you did what you did, you are essentially bulletproof. You are above reproach. And on the other side, if it wasn't documented, it didn't happen at all. So again, I'll finish where I started in saying that the process is more important. We think that we laid out a framework that is not just a sound process, but will help you select the ideal target date fund for your participants. And by selecting the ideal target date fund for your participants and getting more people across the finish line, you're doing the best thing for yourself as a fiduciary. So with that, I'm going to pause there. You all have your PhDs in target date fund suitability. I congratulate you, class of 2019. And Michael, I turn it over to you. And if there's any questions, I'd be glad to answer them.
Well, thanks, Peter. I appreciate all the insight regarding the target date funds and the history that you provided. Looking at the chat box here, and one's coming in, states, do you have an opinion about selecting active versus passive target date funds as a fiduciary?
As a fiduciary, I would say this, that there are target date funds of all different flavors, risk profiles, active, passive, and I would say that it totally depends on the philosophy of the committee. There are some committees that say, look, we want somebody steering the ship, and we know that a good active manager, if they can generate returns that beat the market consistently, that 10 or 15 or 20 basis point differential can mean lots of money on the back end. Now, on the other side of that, they understand that that's not free and that passive investing is very inexpensive. And frankly, over the last 10 years, particularly in the equity markets, passive is done exceedingly well. I would say that that's slightly different on the fixed income markets. And I would say there is no right or wrong answer. I mean, frankly, at Prudential, we decided to actually combine the two. And we offer a hybrid strategy that we think combines the best of both worlds. Active management in areas like fixed income, where managers have been able to consistently generate alpha and beat the market, and go passive in areas where it's expensive to generate those returns. And in order to keep prices low, we offer that combination. I hate to sound like I'm hedging. It's really, there's no right or wrong answer. It's really a philosophical question, balancing that belief in active management versus the expense. We think we offer the best of both worlds, though, with our own strategy.
Perfect. And just last question before we wrap up here. The last one is, are there any asset classes or investments that you think should be included or excluded from a target date strategy?
That's an interesting question. I guess I'll preface it by saying this. There is a general trend in the industry towards consolidating investment menus. So simplifying it, streamlining it, putting the onus of responsibility on the committee to make those investment decisions as to what's good and what's not, and not putting that on the actual participant. With target date funds, you actually have a slightly different scenario in that you don't have to worry about people exposing themselves to undue risk. So for example, REITs, TIPS, commodities, these are strategies that are absolutely a worthwhile addition inside of an asset allocation. But if you're a fiduciary, you may pause and be a little bit concerned about having those as standalone items. And target date funds allow you to take advantage of those non-traditional asset classes. So what I would say is there are some strategies that you probably would want to avoid, the really esoteric things like the triple inverse levered ostrich farm fund. And I'm being facetious. You want to avoid those strategies, but having the inclusion of things like real estate, private or public, commodities, tips, those sorts of things can truly be additive in terms of returns, and likewise really be helpful in protecting on the downside and dampening the volatility or the oscillation that participants experience.
Thanks, Peter. Well, that brings us to a conclusion of our Beacon Pointe Fiduciary Point of View webinar. I would like to thank Peter Cavallini for joining us this morning and sharing his valuable insights on key topics we can expect to encounter in the coming year. This is Michael DeRocco, a retirement plan consultant of Beacon Pointe's Retirement Plan Services, and thank you all for joining. If you would like a copy of the presentation or have any questions, you can reach us at bpawebinar@beaconpointe.com. Again, that's bpawebinar@beaconpointe.com. Thanks again, and be on the lookout for the invite for the next Fiduciary Point of View webinar.